some renegades and there's not enough people to vote, then I mean to vote for its passage, then we will have a problem over the next few days. But if they sign into it, we are still going to have a problem.
Either way, because actually the energy shows that it's also quite volatile in June. So I expect nothing good will come out of it.
Yeah, I'll talk a bit more later. Then perhaps everyone will have a wider idea.
Yeah, okay. So I think we can start today's talk. Good morning, everyone, for tuning in to this live session. As usual, we will start with we will talk about the June forecast, where the theme is transform to progress into the new world, because we will soon be in the new era, as I said about period 9. For those that are not sure what is period 9, you can watch my YouTube channel. I have specifically compiled a playlist focused on just period 9 alone, that what industries will be very much gain attention, will grow in period 9, and also, what do you expect in period 9? Okay, so yeah, as usual, today's talk agenda, we will start with introduction, then disclaimer, then a brief recap of last month's forecast, and also we will look into what are the influences of the 5 elements energy together with the wisdom of I Ching for this month, from the month that's derived from the month pillar, the hexagram, on June 2023. And then PC will give us a very detailed rundown from his global trends research on what he will expect in June 2023, and a summary by both me and PC. Okay, so the disclaimer, as usual, this content is purely based on our study in the global trends and using the research method, which is done by PC, and also the 5 elements Chinese astrology method, which I use to forecast the outcome of this month's energy, that for you to use as a guideline in your investment decision. You need to exercise caution in investment, especially in such volatile situation, and you have to do your own research on what you want to invest. So no stocks advice will be given. Okay, so let's recap on the month of May's prediction, the forecast that we have. So the month of May is a pure fire pillar. Up here is fire, here is also fire. This could represent that, this represents that the fire energy is very strong in May. As we've seen also, there's a lot of chaotic things going on, and a lot of news every now and then. PC has been sending news to our Telegram channel almost like every day. So unless he's taking a leave, I think he was on holiday last week. So everything is volatile, uncertainty, and we also have a very hot weather, right? A hot spell in the month of May as well. So this correlates with the energy. Okay, and also in terms of energy of the fire itself, it also represents, as I said, technology, and also for this year, it is a useful god for financial related matters. Okay, so that's why all the financial related, everything is quite haywire. It's quite volatile and chaotic. So we can see that all these things sort of dominate the headlines, such as the chip war between China and US. Okay, and also again, China and US also aiming for the same side of the moon. Okay, and the flood that ruins the crops because of uneven weather and causes food or agriculture related problem, more layoff. Okay, and then temperature heat wave and temperature hits a high of this one. So this is what has been predicted. The technology war is getting more intense, and the wind of uncertainty with the labor markets that is not very stable. For what we see the layoff, it could just be the starting point. Okay, as I said, it's just an advertiser. There will be more coming up with all this AI that could take over some of the roles, and people will be more effective in their work. So as Microsoft will launch their Copilot very soon, so this is also going to impact the whole job market. Then May Day protest, protesting demonstration is still everywhere in Europe. Okay. And
I think, Evelyn, I
yes.
also want to interject a bit.
Yes.
Right now the protest in Europe is changing from one topic to another topic. So previously it was because of inflation and cost of living, and then it shifted to no NATO, no war, no support for Ukraine, monetary support for Ukraine. Then right now it's moving towards anti-LGBTQT, and on the other side of the SO, you have a pro-LGBTQT kind of a protest that's moving, especially in the US. Target now is Target, the shopping mall, the hypermarket is now being the target of anti-LGBTQT, which are calling for everyone to boycott Target. So Target shares have already plummeted. And similarly, for Budweiser, because they use a transgender person for the Bud Light, so Budweiser now its shares has also tumbled. So right now you have this kind of battle happening more in the US, because US now is as much as they are supporting the cause in Ukraine, their society is actually collapsing. You have black people beating up white people, then you have a lot of irrational policy. For example, California is going to pay every black person, I think, 1 million, and subsequently I think how many thousands per year, so it's going to burn a hole in California's finance by about 1 to 2 trillion. So and California used to be the biggest, the richest
state, in US.
So all
the
this
real
is,
estate there is the most expensive also in US.
So right now everything is deteriorating in the US.
Okay. This is really it's not really very peaceful. We are really very thankful we're in this part of the world. So we talk about the dollarization. It still happen. I think PC has just given a talk on this one also, and the multipolar sort of society. And then in chapter 3, page 17, we also talk about extreme weather that impact on crops, which is also now happening, the El Nino phenomena that we are experiencing now, very hot and suddenly rains. And so all these agricultural related crops drying up due to extreme weather, definitely it will cause also a rise in the food price, as predicted in our book on the astrology and global forecast, in the industry performances for the wood element. And also the chapter 3, page 17 also denotes that the first half or the summer months, now we are in the summer months, that it will be extreme condition that eventually it will burn the wood element. And the wood element, which represent agriculture, will have an effect where there could be shortages of food, or the food prices will increase, and therefore it will trigger more inflation. Okay, so let's look at now. I think the focus will be on the month of June 2023 energy. So because here we have the month of June, related to the earth. This is the earth element, is Wu Wu. Okay, so means that it's mountain. This is a big earth mountain, and also inside the branch here is actually the animal sign is for June is actually horse. Okay, because Chinese astrology, we also divided, besides year is governed by the branch, by the animal sign, the 12 animal signs. The month is also by the 12 animal sign. Even the day also is by the 12 animal signs, and the hour also is by 12 animal sign. So every month in June is actually a horse month. And horse month, what exactly is in horse month? Inside horse month is actually fire. Okay, so this shows that it's a peak of summer, and this is quite pure in terms of energy. So because of the mountain earth comes up, I will expect some attention on property markets. The demonstration against government will also be intensified because the year pillar and the month pillar forms a combination. So definitely people, because this is water, and water represents all the people. So people are also not happy. Okay. So and it shows that now, because they are trying to collaborate with the people, because this is a combo. It's on the surface, on the inside here is there is no combination at all. So they will internally they will compete with each other due to the yin and yang energy. And then also beware that potentially of the stock market drop. Okay, and more layoff will also happen, and energy sector is expected to gain attention because this fire also represents energy. Okay, for the month of June, hexagram is Ting. Cauldron. Cauldron is one of the best of the 64 hexagram before Ting, and then another one is Tai, elevation, and then Feng is this one, abundance. So these three are actually very good hexagram. Also in the month of June. You might say that, in the month of June, we have such good hexagram, one of the most auspicious hexagram. That means in the month of June, it should be very good, right? Okay, this one, the hexagram itself has a lesson here. The cauldron, this is actually a cauldron. This is a feet. This is the cauldron. This is the lid of the cauldron. And then in the old days, people use this cauldron to sort of boil medicine, magic pills. Okay, so the fire itself, and this is actually the fire energy, and here's the wind, means that progress. So the wind will progress or will not blow into the fire to make sure that the thing, the herbs inside is boiled and then become like a long life sort of medicine. Okay, so this is what the sages use. That means the good fortune will only happen if the transformation is successful. That means you will have an output of a very long lasting good sort of magic pills. Okay, so we shall see whether the transformation will be successful or not. Okay, because this is transforming. And also something is also brewing, maybe in June 14, as what I talked about just now together with PC on the Federal's Reserve meeting on June 14 on the interest rate. What is their decision? Okay, so this is for the month of June. Okay, so I think any questions so far for the astrology side? Anyone? Okay, if not, then PC, I will pass over to you. Would you like to share your screen?
Hold on, let me go back to.
What are the downside? The downside is that if the transformation is not this one, it's not successful. Okay, that's the downside. So June is also DE. Okay, what do you mean by DE, Augustine? I know death and emptiness, but where do you get the death and emptiness?
I think can I unmute?
Okay.
Okay,
While
because
waiting for PC.
Together with the together with the year chart, right? You see the year chart, then if the month of June and July is actually DE months, so I'm not so sure whether how it will affect the property market or stock market.
This one I have no research on this aspect, to be very true. Okay, so for human chart, yes, I know lah. But for this one, no, I have no research. Maybe I will go back and study a little bit. Okay, but I can tell you that the market will not be good, I think, for June.
Okay, perhaps later on when I share some of my slides, some of you will have a better idea what to expect. Okay, that is on my own perspective, based on what the other indicators are showing. Okay, then perhaps then you will have some insight of at least what to expect in June. Okay, so just to recap, May, what actually happened? I think we actually forecast gold and silver could rise due to debt ceiling increase, okay, and budget and trade deficits and threat of the dollarization, then risk of banking crisis, geopolitical risk, and central banks buying. But this did not happen. And the debt ceiling talk is still ongoing without any parties reaching an agreement. An agreement was only reached late last night, and I think I've already posted the summary of what has been agreed upon. But as it is, it's still tentative because it needs to be passed by the House, then by the Senate, and then sent to the President for his signing of it into law. And at it stands, there were a lot of Republicans that are very unhappy with the deal because it didn't cut a lot of government spending. And I think the other thing is that if the debt ceiling was approved much earlier, then perhaps we will see gold and silver reacting more positively. But in the back of it, I think the Fed is also trying to defend the dollar. Because of all the talk about the dollarization, the dollar actually went back down to breaking the support of 100 in the DXY. So what happened was then a lot of Fed officials, I think for the last 2 to 3 weeks, there were a lot of Fed officials that were actually involved in live seminars or in live talks and those events. And all of them are saying that they need to hike interest rates. So what happened was that there is a push to actually go long on the dollar and sell gold and silver. Now, the other thing that happened was that because the debt ceiling agreement has not been reached, a lot of people have been selling treasuries. Investors, people who are very worried of a potential default, they actually were selling treasuries. So what happened was when you sell treasury, the yield ultimately goes up. So when the yield goes up, what happened was people will believe that the Fed would have no choice but to raise interest rate in tandem to match the yields in the US Treasury. And therefore, it caused other traders, especially the algo-driven trades, to go short on gold and silver and long the dollar because of the behavior of the market forces. So this is how it could have transpired, that all because of the debt ceiling talk. So in that sense, what happened is only, I think, lasts for maybe a few days. But once, if they sign into bill, then we are going to see gold and silver and commodities would continue their march on the upside. Because included in the bill agreement, if you have looked at it, was an approximately additional of 4 trillion that is needed all through until at the end of 2024. So if you add 4 trillion into the US debt, which currently stands at about close to 31.6, let's say 32 trillion, okay, then that would actually increase the US debt to 36 trillion. And if the Fed continue to raise interest rate, let's say at up to 6%, okay, that means if you are having a debt of 36 trillion at 6%, the Fed is effectively paying, you know, if let's say 36 times at 5%, it is already 1.8 trillion. So at if you add another 1% to it, then the Fed would be paying, you know, 1.86 trillion just to service the interest. So that is why this time when they need to refinance their debt, there's not going to be many takers. Okay, so that is why there's going to be a lot of volatility, even if the Fed, even as the president signed the new agreement into law. So actually, it is very astonishing, because the sell-off in Treasury itself, you know, is an action to rid oneself of US denominated assets. So by right, the US dollar should not be going up, because when central banks are selling their US Treasury, it means they do not want to hold anything associated with US dollar. But because when it comes to the trade, about 80% of the trade are determined by algorithms that run on the exchanges or run by fund managers and such, that will only detect headline. It will not analyze the fundamentals behind such a move. It will just detect the headline. Okay, yields goes up means buy US dollar, sell gold. Okay, and that's how the trade has always been, because it's driven by algo. So when, for whatever fundamental reason, when the purpose of a price action, you know, is derived from the fundamental action itself, then, you know, you will see a huge reversal, and therefore people will sell dollar and they go into commodities. So that is how the world trading is being managed right now. So because of the situation with the debt ceiling, the strong US dollar, the expectation of higher interest rate, it also provides the bullion banks to go massively short to force the liquidation of long positions in order for them to cover their massive short positions. So this is how bullion banks manage the whole commodities market. So if the dollar is strong, the algos will come in, then the bullion banks will actually ride on the wave and short massively. So why do they need to short massively? Because the bullion banks are actually sitting on a paper loss position in the gold trade of about $35.1 billion. Okay, and after their short last week, I think they are now hovering around 33.5 or something like that. So they have managed to reduce their short position by a few $billion, their net loss, paper loss. Okay, then they're also suffering net loss position in silver by about more than $1 billion. So that's why they short silver as well, so that when the algos they continue to short, then, you know, it creates a cascading waterfall effect. And then when it reaches a certain bottom, then the bullion banks would massively start to buy back, and then they cover their shorts. So before, way back, you know, 5-6 years ago, the bullion banks action would have resulted in the gold price, you know, dropping by $60-80 a day. But right now, because of certain regulations within the context of the Basel III rule, they are not able to manipulate as much as they can as they could last time. So that's why, gold dropped by, less than 20, then sometimes it goes to 30. So it's always within that range. So, but I think if once the agreement has been signed into law, the debt ceiling agreement has been signed into law, then I think, it will create a position, create an opportunity for people to go back into buying commodities, gold and silver and such. Mainly because if you have read the text that I sent this morning, included inside is that after 2025, there will not be any budget cap, which means there's no more debt ceiling. The US can print however they like, however it suits their purpose, okay, to continue their financialization of the global economy. Now, if that ceiling is removed after 2025, then the US can print at any time it wants, okay, and then it will create more inflation in the US. And I think if that is signed into the law, a lot of people will start moving into gold to hedge, because if the US continue to print money or issue debt, like a drunken sailor, then people will have no confidence in the US dollar. So in some effect, that is also the reason why people want to de-dollarize. So we also forecast that the BOE and ECB could turn dovish, but both continue to raise interest rate despite weakening economic data. So everywhere, people are demonstrating in Europe. So my expectation was that the ECB and the Bank of England should actually, put a stop, okay, because of, even if they hike interest rate, it is not stopping the inflation. For example, inflation in the US here, in the UK, the CPI came in not very high, but food actually went up about 20%. So instead of giving some breathing space, okay, to the consumer, they continue to hike interest rate. So what happened last night is that the British government said that supermarkets should actually put a price control. They have intention to implement price control. Now, price control will only cause inflation to go up higher because a lot of people want to hoard, okay? And when people hoard their products, because when you control the price, people are afraid that in the future they will not be able to get it as cheap, so they buy a lot and they start hoarding. So that would remove more goods from the warehouses and such. And if, let's say, hoarding becomes a habitual thing, then you actually have shortage of goods, which then will lead to even higher inflation. So price control is never a very good option in fighting inflation, okay? And then, of course, the ECB will still continue, to insist on rising interest rate. But where we got right. So first and foremost, we actually mentioned that there'll be stress in the CRE market, and this is quite true. And in the publication on 9th of May, the Financial Times reported that US lenders warned that commercial property is the next shoe to drop. And according to FT, the US CRE market, means commercial real estate market, which is worth an estimated 5.6 trillion, is facing a combination of empty buildings and rising interest rates. Now, previously I've mentioned that a lot of the companies or REITs or investors that own buildings, okay, they need to refinance the bulk of their loans between 2023 and 2025, and that is estimated to be a few $1 trillion. Now, a lot of them were actually given a grace period at very low interest rate after the financial crisis in 2008. So all this, they need to refinance. So what it means is that they are, because of the work from home culture right now, And because of implementation, more companies are looking at AI as an alternative. There's lesser requirement for people to, companies to house the employees inside an office. So that's why the office vacancy rate in some of the major cities have gone up to 20%. Okay, and they have falling revenue, but they are in urgent need to refinance their loans that were actually given a breathing line, okay, a breathing space in a post global financial crisis at very low interest rates. And right now that interest rate has actually snowballed higher, and a lot of these REITs and companies that relies on debt to finance their operation could face problems. Yeah, so that's why the CRE market is very vulnerable. Then we also highlighted that US companies face rising costs, and the fall of the NFIB index could herald more problems ahead for small businesses. And this is what is happening now. Bankruptcies spike among small and private companies. You can see how high it has gone up, okay, much higher than during the COVID period. And then these are the bankruptcies, okay, that happened, okay, in the first 3 weeks of May, that has been higher, okay, than other periods, okay. So it shows that May has been spiking up. And why is it important? Now, the small businesses and private businesses employs more than 50% of Americans. Now, if let's say they are going into bankruptcy, that means that a lot of people are going to lose their jobs, okay? And the implementation of AI eventually would further erode the amount of people that are required to perform specific functions within an office environment. So we also forecast that major economies could see dramatic slowdown, and Germany just entered into a technical recession after having two negative reading on its GDP for 2 quarters. So China economic recovery gathered steam as domestic tourism saw massive growth. So in the January to April period, railways nationwide handled 1.12 billion passengers trip, up 119% from a year earlier, according to the China State Railway Group. In April alone, about 328.6 million rail passengers trips were made, surging 477% year on year. So if you go back to our last month's video, we mentioned that all indicators are pointing towards a revitalization of China's traveling that will herald more spending and such. Yeah. So let's look at the US recent economic data. So the CPI came in at 0.4% month on month, and year on year it grew 4.9%. So it shows that inflation is coming down. Okay. But as I mentioned, since last year, that the US measurement of CPI has changed over the last few decades. If we were to follow shadowstats.com, which used back the same metrics that the CPI was calculated since the 1980s to 1990, US inflation currently is closer to about 10 to 12%. So core CPI came in at 0.4% month on month, and year on year it grew 5.5%. So you can see that the overall CPI has been much lower than the core, okay? And that the core is what worries the Fed most, because the core, if they are unable to bring it down, means that it's going to be a sticky inflation. Sticky inflation means that they need to hike interest rate even higher, okay, to reduce the to force the core inflation to go lower. But of course, we all know, if let's say the Fed continue to raise the interest rate higher, more companies' bankruptcies will happen, resulting in more layoffs, and the US government have to borrow more to serve its interest payment. You know, a host of problems actually comes with it. So I think, however, whatever the Fed will do, okay, the Fed will be unlikely to bring the core CPI below 2% without severe damage to the US economy. So we are talking about a depression-like scenario. So PPI came in at 0.2%, and year on year it gained 2.3%. So one of the reasons for the PPI that came down low was because of the strength of the US dollar, which resulted in lower price of commodities. We see that, you know, a lot of the commodities have actually fallen down about, you know, some commodities anyway, by about 20 or 30%. So that is what caused the PPI to come down. So core PPI came in at 0.2%, and year on year it gained 3.2%. It's still, core is still higher than the normal PPI. So retail sales came in at 0.4 month on month in April, and year on year it gained 1.6%. Now this is the slowest year on year growth in retail sales since May 2020. So if we look at it with the CPI at 4.9%, retail sales after adjusting for inflation is actually in negative territory. So sometimes, you know, the stock market move in tandem with headline, okay, but no one actually looked into the key information that how inflation would actually have yielded negative growth, okay? So the National Association of Housing of Home Builders Index came in at expansion level at 50. Housing starts jumped 2.2% in April, while housing permits fell 1.5%. New home sales surged 4.1% month on month, but that was after, you know, an adjustment in March, you know, from 9.6% growth to 4%. So year on year, it gained 11.8%, and pending home sales were unchanged, okay, in April, but year on year, it still fell 22.6%. So these are showing a lot of mixed signals where the housing market is concerned. There are some positives, there are some negatives. But let's look at the whole issue on a wider scale. Now, US households took on more debt as household debt limit hit 17.04 trillion, which is a new record high. So US continues to see 25 consecutive months of negative real wages that they earn after adjusting for inflation, resulting in households taking more debt to fund their livelihood. So if you could recall, last month I mentioned that some people are actually skipping a meal a day, you know, to save enough to pay for their mortgages. Okay, so this is telling you how undesirable the debt situation is. So households are also incurring credit card debt to fund mortgages. So that is why credit card debt has actually gone up as well. And what could happen is that because the household are actually taking on so much debt, okay, using one type of debt to service another type of debt, we can see delinquencies rising, especially when the Fed starts to hike interest rate. So if business are collapsing because of high interest rate, lead to layoff, then these people who are saddled with debt, what do? Okay, so that's why we are going to see higher delinquencies or potentially, you know, forced foreclosure of their homes. Yeah, Evelyn, you have something to add?
Yes, that's right. DC, you say about people skipping a meal. Actually, another thing is that I got to know that some people, regular people, that also, you know, instead of buying meals, they go to those food bank for free meals now.
Yeah, it's
very
very, yeah. And if you look into the detail that I sent in the Telegram channel today, they are going to raise the eligibility of a person receiving the free meals from the government from age of 49 to 54.
Oh,
Okay. So they that means a lot of people will actually face hunger, you know. And another thing, the student loans which ever since COVID, yeah, they have been deferred from paying. If this is signed into law, they need to start paying by July. So all the while the students loan, you know, they no need to pay back. You know, there's always a moratorium that keep on delaying their payback. So if they sign it into law effective of July, they will actually have to start paying. So all these student loans, okay, which amount to more than $1 trillion, I think about 1.6 trillion, those recipients of the student will have to start paying back their loans. And faced with high credit card debt, housing loan debt, automobile debt, student loan debt, you know, this is going to cause a tectonic shift in consumption. And that is why very likely the US would actually see it falling into a recession. And if we look at the housing, okay, this is a very detailed chart by Nick Gurley. Okay, he's showing that now the cost to buy a home at current interest rate is already $2,700 per month. And the cost to rent a home is just $1,600 per month. So what will happen is that people do not want to buy a home, okay, despite what the economic indicators are showing. I think this, you know, like the new housing starts, pending home sales, you know, all those are actually historic data. But this is the current data, which actually gives some insight into what will happen in the coming months. Okay, because if the cost to buy a home increases, people do not want to, there's no reason to buy a home when you can actually want to rent, which is actually cheaper. So as more people rent, then the rent inflation will actually go up. Okay, and rent is actually one of the core CPI that is measured. So if people do not want to buy a home, okay, what will happen to the inventories of new homes that are being built? So very likely they will give discount and all those, like what happened over the last few months. You know, builders actually built new homes. There were lesser takers, so what they do, they offer discount, and then, you know, there were a lot of people wanting to buy. Then they say, hey, you know, the market is good, let's build more new homes. So that is why when they offer discounts, we see an increase in new home sales. Okay, and because there's an increase in new home sales, home builders themselves suddenly became very confident, okay, and say, let's build more homes. Okay, and that is purely driven by greed because they think there's a market. That is why the National Association of Home Builders saw an uptick into expansion, where the previous few months it has been in contraction. So this kind of chart actually helps to give some reason why, you know, the economic indicators behave as such. And then, you know, you can see that the mortgage application to buy a house actually have dropped, you know, very steeply. And this was during the time of the global financial crisis, you know, the housing crisis. Okay, it reached this level, but then you see right now we are already in deep red. So it is like the narrative of the Fed, narrative of the US Treasury, and the narrative of the Biden administration. Hey, economy is okay because employment is still good and such. Okay, but the employment are all low-paying jobs. If the employment is so good, then why are the household incurring record credit card debt, record household debt? So you can know that the whole economy, that the US, you know, whatever people say about resilience, you know, and is driven by narrative, trying to tell the world, okay, that everything is fine. But all these are underlying factors that tells you something is very bad okay, beneath the surface. And it's just waiting for the opportunity to bubble up. When it bubble up, it will explode to the surface, then we'll see a lot of misery. So we can see that there's still a risk of banking crisis, even though suddenly everyone pays attention to the debt crisis. But deposit withdrawals have been falling, okay? And the thing is, the higher the Fed, the higher the treasury yields are, the more people want to withdraw their money, their deposit from banks and invest in money market funds that offers a higher return, okay? Because banks are still offering 0.5, less than 1% from their cash deposit. So people withdraw their deposit and invest in money market fund that offers about more than 5% return. So it is still happening, okay? And if let's say they high interest rate again, then the US Treasury yields will also go up in tandem. And if let's say that happens, then more people would even want to withdraw, okay? And then those banks that actually bought US Treasuries when the Treasury yield was at 0.5% versus a yield that is currently close to 4%, then it signifies that their paper losses, okay, is tremendous, okay, because from 0.5 it goes up to 4%, then that is a huge fall in the value of the government bonds that they hold, okay, and that means that their equity is being threatened. So besides the risk of debt crisis among consumer, the risk of a credit crisis in the commercial real estate, okay, and the risk of a banking crisis returning, then we also have a credit crunch. Okay, now the M2 money supply growth is pointing towards a credit crunch as banks withhold lending and risk of default rises. Okay, now even as more companies go into bankruptcy, banks will become even more aggressive in not wanting to lend out the money, okay, because of the risk of failure. So right now, what we are seeing is that the M2 money supply growth have not reached this level since the Great Depression. Okay, the last time it reached negative was during the Great Depression. And this goes to show that it also magnifies the risk in the CRE market as major commercial real estate companies need to refinance the bulk of their debt from 2023 to 2025. Okay, just as they want to refinance, the bank says we got no money to lend. Then what will happen? Okay, so what will likely happen is that it's already happening. If you go to our last month, we already say that certain real estates are being sold at huge discount, okay, 30% discount or 40% discount, okay, to buyers because they got no avenue to refinance their loans. So that is why, okay, the CRE market is also will be the one that will suffer, besides the normal corporation that due to this credit crunch will actually have to pay much higher interest to refinance debt that they have borrowed at a very low interest. So this is a chart that shows that, like here, we know that the M2 money supply growth have actually fallen. But what is interesting is that even though it has fallen, but then inflation is still there. It has not reached a deflationary level. Okay, like if we want to go back here all the way into history, this was during the Great Depression. Okay, so the money supply is shrinking for the first time since 1932, the Great Depression, from a greater relative height and steepness. Okay, you can see this, the Great Depression, and this is what we are saying. So this is what the author means. Okay, Ted Rees means when he says that, a steeper fall. Okay, now the rate of M2 growth has fallen 31% from its peak, which means from here to here, okay? Generating disinflation or slowing inflation of about 5%. So that is slowing inflation, but if we want to compare, okay, there was a peak from 12% to negative 10.5% in actual deflation. So actually, from 12% to 10.5% is just a drop of 22% to form the Great Depression. Right now, we are dropping at 31%. So this is what the author tries to highlight. And that fall in the money supply growth being much greater than the Great Depression. And we are still not seeing inflation falling into deflation. We still have core inflation at 5.5%. So that is why he speculated that if the US government is unable to hold back inflation, but they keep on dropping the M2 money supply growth, then what we will be seeing is an inflationary depression. Okay, this will be the mother of all economic disaster. Okay, and he's already warning us about this. Yeah. Now, what could happen in June? First and foremost, the risk of recession has not abated. So the Empire Manufacturing Survey here, okay, the Philly Fed survey here, okay, and the Fed's leading economic indicators are at levels where recessions have happened in the past. Okay, you can see that we are at this level, and all this level we actually see, already see a recession. Right now we haven't seen yet. So which means, it's still being pressed hard, under the water surface. It's like a ball. Okay, when you press it hard underwater, what it does when you release your hand is that it will just shoot all the way up and explode out of the water. Okay, and that is what is happening. So the Philly Fed survey, you can see that we are already in areas where it has triggered recession previously, as were the case, okay, of the Empire Manufacturing Survey. So all these are telling us that recession is already here. It's just that I believe they are trying to push the narrative that everything is okay through the jobs report, okay, by manipulating the inflation report so that the real GDP is positive rather than negative. So what are the other things that could happen in June? Now, initial details of debt ceiling agreement, raise 4 trillion in 2024, and thereafter there won't be any more debt ceiling cap. Now, if let's say that happens, I think as the years progress, the US government keep on printing money, the US dollar will actually continue to fall. Now, debt ceiling agreement will result in market turmoil due to lack of liquidity in the market. As I've shown you just now, the M2 money supply has fallen into negative territory. So Treasury Department needs to raise 1 trillion to cover shortfall for the rest of the financial year until September. So Fed could trigger sell-off to force a move into US Treasury or become the buyer of last resort. So there's only two things that the Fed can do. Okay, if it wants to force people to go into the US Treasury, all they need to do is to trigger a sell-off in the market. And the Fed can do it because the New York Fed actually has the US largest trading desk. This is what they use, okay, during the period where the stock market suddenly collapsed and they try to support the market. So they have what they call the plunge protection team. Okay, so the Fed could do this if they want, okay, because they want to stop raising interest rate. Because if the market continue to goes up, it means that there is still a lot of risk takers in the market, and they have to force themselves to raise interest rate even though the economic indicators are very, very weak. Now that could cause a huge problem for the Fed when it goes into recession. So what the Fed want to engineer a soft landing. So what they could do is that they force the risk takers out of the market by allowing the stock market to fall. And because they need to raise so much money for the US Treasury, when the market falls, people will rush into US Treasury as a safe haven. So that allow the US Treasuries to be taken up, okay, by people fleeing into safe haven asset. Now, if the Fed do not want to do this, the other option is that they become the buyer of last resort, and that means QE. But the Fed would not want to do QE at this stage because interest rates are still high. Okay, they already tell the world they want to do QT. If any moment they mention something like QE, then the US dollar would drop. So actually the Fed right now is in a very difficult position. Do they want to support, okay, the market, or they want to support the US debt, okay, or they want to support the US dollar? And out of all this, they can only choose one type of action. So that's why the debt ceiling agreement could result in weakening of US dollar due to the debt ceiling abolishment. Could see inflation returning as price of commodities rises, good for gold and silver. So CRE market could see further weakness, more bankruptcies and layoffs because of higher interest rates, because of a lesser requirement for human input, because right now there's inputs from AI, and household delinquencies could rise. So these are the things to look out for. Now let's look at Europe. Europe's powerhouse economy, Germany, has slipped into recession after Q1 2023, with GDP coming in at negative 0.3%. After Q4, GDP came in at 0.5%. So France barely scraped through Q1 2023 GDP, coming in at plus 0.2%. After Q4, GDP was flat. So we are forecasting since the beginning of the year that Germany deindustrialization will prove to be costly for its economy, while France's continual protests and demonstration could soon take its toll on the economy. Now, of course, France's saving grace was its lower energy costs, which helped cushion the rising cost of energy experienced elsewhere. So France was very smart. They never shut down their nuclear reactors. Germany did the opposite. They shut down their 3 nuclear power plants. Okay, so right now they actually have energy deficit. So of course they try to make it up through importing a lot of coal, okay, which ruined their ESG agenda. So the UK saw its Q1 2023 GDP coming in at just 0.1% after Q4 GDP was flat. So you can see that Europe is seeing very little growth or flat, and that is a premise for worst thing to come. Okay, so US continue to be assailed with high inflation, which with CPI now sitting at 8.7% year on year, far above Germany 7.2% and France 5.9%. Now the irony is that despite such weak economic data, the DAX, the Kakaron, and the FTSE are all at record high levels, suggesting that a major correction could be very painful. So the people are, this is what we call a huge, there's a word for it, slipped my mind. Okay, there is such a huge gap between reality and fantasy. Okay, the stock market is driven by fantasy, okay, but the reality is everything is breaking down. Okay, that means that when the reality finally sets in, when fantasy becomes reality, there's going to be a huge drop. So Europe market, is just like that. Okay, the people still believe that things can be better. And the worst thing is that Europe has announced through NATO that they need to go into a wartime economy, because right now suddenly they are going to fight the Russians. So in a wartime economy, it will lead to very low productivity, because if you invest in plant equipment, infrastructure, you invest in education, these are all necessary to improve productivity. When productivity improve, then you have GDP growth. But if you invest in a military equipment, there's no productivity from there. That equipment is going to go to war and then it's going to be destroyed. So there's no other people that will benefit from that. So when you invest in military equipment, it doesn't create productivity. Worse, it pulls out important resources for the construction of military equipment versus the manufacturing of goods for consumption. So what we have would then be limited goods, okay, money spent on non-productivity item. So we have inflation and low GDP. So what is that? Stagflation, okay? So this is also going to happen to Europe. Now, let's look at China. Now, China is a very different story. Now, China's CPI only came up at 0.1% year on year in April, while core CPI came in at 0.7%. So year on year, China's inflation is very low versus its counterparts in US and Europe. So PPI came down to negative 3.6% year on year in April, a further 1.1% percentage points decline from March. Retail sales came in at 18.4% year on year in April, 7.8 percentage point higher than March. Industrial output went up 5.6% year on year in April, 1.7 percentage points higher than March. So you can see China is the reverse side, okay? Because China economy did not take off during the after COVID, okay? 2021 was okay, 2022 was struggling, whereas the Europe and US pumped in a lot of money in 2020, 2021, and that's why, you know, right now their economy is stagnant. But China has extended its period of observation, lockdowns, control, and right now, you know, it is seeing its economy gradually recovering. Now, the production index of services sector rose 13.5% year on year in April, 4.3 percentage points higher than March. Now, in the first 4 months, fixed asset investment rose 4.7% year on year to 14.75 trillion renminbi, with investment in high-tech manufacturing and services increasing 15.3% and 13.4% respectively. Meanwhile, China's investment in property development went down 6.2% year on year in the first 4 months of 2023. So this goes to show you that since 2021, with the curb on speculation on housing and such, it has taken a toll on the residential property market. People are no longer vying to, you know, push up prices to speculate. So this is a good thing because, you know, it has deflated the bubble, okay? It has deflated the bubble in the housing market, okay? But China still spends a lot in high-tech manufacturing and high-tech services, okay? Because that is how they want to improve their productivity. So China's surveyed urban employment rate stood at 5.2% in April, down to 0.1 percentage points from March. Now, one of the other things that underneath this is not all pleasant for China also, because a bigger percentage of the people that are in the unemployment rate are actually the youth segment. So young people graduating or young people coming out from school, they consist the highest portion of the unemployment. So that could pose a challenge to the Chinese government. Now, here are some major takeaways in China that will actually perhaps highlight what is in store in the economy over the coming months. Now, electricity consumption by the industrial sector rose 5.2% to 1.83 kilowatt hour, accounting for 65.3% of country's total electricity use. So in April alone, the industrial sector used 474 billion kilowatt hour of electricity, an increase of 7.7%. Now, if we look at it, this is the average use over the 4 months, but in April alone, it's 7.7%. So that goes to tell you that economic activities are being ramped up. So in April, the number of China-Europe freight train trips surged 25% year-on-year to 1,459. The trains transported about 160,000 TEU of goods, means 20 equivalent units, which is the size of the container, representing an increase of 45% from a year ago. This goes to show you that the BRI, is played to full effect by China to export its products to Europe via overland. So more connection via Central Asia to come. So January to April period, railway nationwide handled about 1.12 billion passenger trips, about 111.9% from a year earlier, according to China State Railway Group. In April alone, about 328.6 million rail passenger trips were made, a surge of 477.4% year-on-year. Domestic tourism is picking up, and this would lead to increase in retail sales. So you can see that this 444% actually contributed to the 18.4% increase in retail sales. So in May, we will probably see similar figures, and therefore, because May was a holiday, they have the Golden Week holiday, okay? But in June, we may not see the same growth as in May, but then with April and May becoming strong, and June probably will do much better than June 2022. I think China GDP for Q2 could be stronger than Q1 2023. Now, the other thing is that earlier, before most of you all log in, Evelyn and I were discussing about uranium and things like that. So if there's one sector that you need to pay attention to if you are interested to invest, would be in the China nuclear energy sector. Okay, if you do your homework, okay, you will know which the stocks are. Okay, so you can see that China newly installed capacity of wind and photovoltaic power. Now this is the green energy, yeah. Okay, reached 62.51 million kilowatt from January to April. Okay, and the figure accounted for 74% of the country's total newly installed capacity, up 11.5% from a year ago. China's wind and photovoltaic power generation reached 482.8 billion kilowatt hour during the period, up 26.8%. Again, when you look at all this power generation and such, that goes to show that economy is picking up. Now, China's proposed build-up of nuclear reactors in the coming decades will dwarf the rest of the world combined. So here, already telling you that one of the sector that you should look at, okay, is the China solar sector, okay, and the China nuclear sector, and China wind sector as well. Now, there's one particular company that has been very efficient way on how it generate wind electricity from wind energy. So it actually has a floating fish farm, okay, and that floating fish farm on top of it have actually wind turbines, okay. So that is how that particular company has actually used aquaculture and combining with wind energy generation. So that is how China have actually evolved, okay, from being single purpose minded in achieving something. Right now they are looking at where else can they expand and grow additional inputs to the economy. Okay, for example, solar farms in China, Most of them are in the in some of the rural areas because they actually they create a new housing area for the people, move them out from their decrepit homes and villages. So they are housed in a new housing area. Then they give them a plot of land to farm, but then they also hire them, okay, to monitor and to inspect the huge solar farm, okay. So what they do is that the huge solar farm, often what they face is that they have a lot of grass, and that grass would eventually cover part of the solar panels, and then, you know, it will lead to deficiency in electricity generation. So what they do is that they build they encourage the locals to raise lamps, okay, to raise lambs, which then they will actually crop the grass, okay. And then meanwhile, the people will also have additional income from the sale of lamb meat, okay, to the external market. So that is how they are doing. And floating fish farm, because of the because they have floating fish farm, and because certain part of the lake is a huge part of the lake is covered from the sun ray, and it creates the right temperature for certain fish to be to grow in that area, okay. And then they can actually harvest the fish that is raised that is reared in that lake, okay, for additional economic gains. So this is how China is doing, okay. And if you look at it, this is the chart that shows the number of nuclear reactors that China is going to build, okay. And there are only 2 listed companies that are related to China's nuclear power, listed in Hong Kong, okay. You can actually search and you will know, okay. So I myself own those 2 stocks as well, okay. So, and if you look at it in terms of nuclear power generation, one of the stock is actually been steadily increasing its dividend. So if you can imagine that right now it has only about, I think, 20 or so reactors, is going to build a few more. What will happen if, let's say, it built another 50 or 60 more? So that dividend yield is going to gradually increase, okay. So these are one of the sectors that you should look at, because the US market and the European market have all reached, you know, very, very high valuation. Whereas, you know, you look at the Hang Seng Index. Hang Seng Index right now, even though, you know, Hang Seng Index have been in a recession mode, okay, ever since reaching a high of 29,000 points, you know, right now it's moving between 19 to 20,000 points. If you look at the European market, it's all at record high levels. If you look at the S&P, it's just you know, it's just about 7 or 10% away from its record high, okay. So if you look at the Hang Seng, at, you know, it is trading at almost 30% discount from its all-time high. So that's the difference in terms of potential market gains in the future. So the other thing is that in Q1 2023, China overtook Japan as the world's largest exporter. So, and this is why now China automobile exports maintain the trend of strong growth in the first 4 months of this year. Total of 1.37 million vehicles were exported during the period, surging 89.2% from 2022. Passenger vehicle export jumped 110% year-on-year to top 1.14 million units, 1.5%. Now, in the January to April period, export of new energy vehicles saw 1,000 units to 170% to 348 units. So now the China auto sector is thriving, and this will lead to more application of high-tech equipment in the manufacturing sector. Okay, so if you look at it, China vehicle have reached the has become the world largest. So one of the key things you could look at is who are the primary players, okay, in the China's EV market, okay, and this is another auto sector. China's auto sector is thriving and will lead to more application of high-tech equipment in the manufacturing sector. And President Xi, on AI application, this is what he wants. Okay, accelerating the construction of a modern industrial system bolstered by the real economy is crucial for us to gain strategic initiative in future development and international competition. So this is what he has in mind. Now, China is not going to use the development of AI purely like what the US is doing, okay, as software as a service, okay, not in that sense, but not in the only way that they see the application of AI, but they want to expand it to the manufacturing sector, okay. So if you look at it, China will lead in a lot of future high-tech fields. Now, out of the number of patents that's granted in 2021, 88% were to these few countries, and China actually takes up 38% of it, and the USA is just 18%. Now, if you look at it, in computer technology, electrical machinery, digital communication, measurement, all this, China is playing a leader, and China tops in all 29 fields versus the US in 4 fields and Japan in 3 fields. So that's why, if you want to invest for very long-term gain, my belief would be to look into China, okay? And right now, there's a currency war that is being fought, okay? There's a lot of sanctions from US against China, and that is why investors, those heavy investors' money from the US and Europe is not going to China. But I think that, China economy will continue to grow, and eventually the people will actually invest back into the economy. And US and Europe will continue to decline, and the de-dollarization would actually create an environment whereby it will pull a lot of money, okay, from elsewhere to invest into China. And I think that is when we see, the Hong Kong Exchange, Shenzhen, Shanghai, all would start to trend up. Right now, they are at the infancy stage of what the NASDAQ experienced, about 20 years ago. So I think that's tremendous momentum as the economic picture unfolds. So what could happen in China in June? Now, China will continue to see low inflation versus its counterparts in US and Europe. This will boost consumption. So domestic tourism could play a major role in meeting the country's dual circulation policy. And a lot of countries have been complaining that there's not enough China visitorship based on the kind of preparation that they have made. Okay, there's fewer visitors to Australia, to Switzerland, to Europe, to Japan, to Korea, and that's why you see the surge in China railway passengers trips, because domestic tourism is gaining popularity. They want to support back their own economy as a priority. So economic activities will continue to pick up as energy consumption patterns suggest that this is the current trend. Now, trade via BRI will continue to grow, and new JVs with trade partners will be announced. So here I'm giving some indication. What are these companies? So BYD and CATL is aggressively expanding in Southeast Asia. So BYD is very aggressive in Thailand. They're also very aggressive in Indonesia. And in fact, BYD and CATL is helping Indonesia to develop into a full vertical integration of the new energy economy, because Indonesia have a lot of nickel, okay? And nickel is an essential part of the battery for EVs. So CATL is helping Indonesia develop the battery. Okay, BYD is helping Indonesia have a full integration of its electrification. Okay, from using nickel, BYD also have their own battery. Okay, and then developing the motor vehicle and then the supporting industry. Okay, so that is why I think the battery minerals, even though that the price of lithium has fallen from 80,000 to 30,000, more than 50%, but I think Asia, with the total population of several 100 million people, like I think I will put it close to about, I think 500 or 600 million people. When this take off, okay, the electrification take off, then it will create another growth sphere. Okay, and it also augurs well for Southeast Asia. That's why I think Southeast, even though if eventually the US and Europe will decline, likelihood we will see the kind of reaction like what we see during the global financial crisis. Asia was hit hard just for a while, but it was not as strong as what happened in 1997 and 98, where we see a prolonged recession, okay, due to the currency crisis. But if something bad happened to US and Europe, okay, then Southeast Asia will take a very immediate hit, but I think it will rise back up very fast as well because of our trade relation with China. Okay, so China will maintain the lead in auto exports, and China trade with partners will continue to expand, and that will actually help buffer Southeast Asia. So some whispers of tech development in the semiconductor industry in China, narrowing the gap with foreign counterparts, could see more Chinese semiconductor firms benefiting. So again, this is an indication of, I mean, if you look at it, NVIDIA is trading at 200 times its earnings, something like that. And, some of the Chinese semiconductors firms, they are trading at much lower PE. Okay, so it depends whether you want to ride on the hype, okay, where a stock has become so overvalued that it has become very ridiculous, or you want to look into how Chinese semiconductor firms are now being hit because of the sanctions, but once they have found their footing, they have discovered their own technology, then there's no stopping them. Because I think what will likely happen is that now already there's news that a university in Harbin has actually found a way to look at extreme ultraviolet light, okay, which is a precursor to developing an EUV, okay, for lithography machine. And Huawei has already developed its own technology for EDA. And recently, a Chinese company has come up with its own solution to design chips, which is reported to be, progressing and able to catch up with ARM in the coming years, 1 or 2 years. So all these are actually fermenting in China. And I think that if China is successful, either, in their photonic chips development, which will actually herald another new semiconductor kind of development, or, still using the silicon-based type of semiconductor, if China has found its own way, what will happen is that China will dump all this into the market, okay? And when they dump all this into the market, then the US will have lost its share of the global dominance, okay? So if you are patient, then you should look at all this. But if you are a trader, you might want to trade with the wave. That is what's happening in a lot of the tech stocks currently, where 10 stocks actually dictate the S&P gain since its bottom. If we take out the 10 stock, okay, the S&P had not gained at all. So it depends whether you have the mentality of a trader or you are an investor that you're looking for the long term. So last topic on global geopolitics. China play a role in the development China to play a role in the development of Central Asia, especially in infrastructure development and the development of the resource industry. Now, China signed a deal with Afghanistan to help develop its resource industry, and more than 30 countries showed interest to join BRICS. However, recent skirmish between Afghanistan and Iran could complicate matters. Both are important to the BRI and INSTC, which is the International North-South Transport Corridor, from Iran all the way through the Central Asia to Russia and then to Europe. So Europe and US will continue to support the war in Ukraine. Europe will probably head towards a wartime economy, which will be disastrous to its economy. Ukraine are now using weapons from the US and Europe to attack Russia, which have been prohibited by the US and Europe. Now, this escalation will lead to potential expansion of the conflict area. So that means war could expand to greater part of Ukraine, or even right now we see incursions of Ukraine troops into Russia, as well as a potential target in Belarus. So US and Europe will provide Ukraine with F-16 fighters. The cost of the war is escalating for both the US and Europe, and the weapons getting deadlier. Both the US and Europe have gone too far deep to extricate themselves out of the conflict. Okay, once you have gone so deep, it's like, you have lost all sense of reasoning except to inflict the maximum damage. So that's why I think US and Europe will continue to burn money in the Ukraine black hole, and it's not going to make anything better. So meanwhile, US continue to expand its presence in Asia Pacific. They have expansion in Guam and Philippines and a new base in Papua New Guinea. So now, according to the Global Times, China further reduced its holdings of US Treasury in February to the lowest level in 13 years, falling to 848 billion in February from 859 billion in January. Now, this is a decline of 10.6 billion. You can see that China is de-dollarizing gradually, not rapidly, because they are trying to balance, because no matter what, China still have trade with the US. So other foreign holders cut their holdings by 4.7% year on year to 7.34 trillion. So not only China, but other foreign holders as well. Now, that indicates that, why I mentioned just now that the US Treasury, if they want to sell so much Treasury to raise 1 trillion to finance for the remaining fiscal year, they would actually face a lot of challenge, because foreign holders are not going to buy. Okay, instead they are dumping. So how do they want to convince, people to buy Treasury, which then I think will be left to the Fed to see how they would fit in. So as more countries opt to settle bilateral trade in renminbi, we could see further erosion of Chinese US Treasury holdings. Now, on May 2023, PBOC made it possible for Chinese citizens to own gold by linking their savings account with a gold account digitally. The citizens can start saving in gold from as little as 1 gram and exchange the digital gold for physical gold at varying sizes. Now, the above could be a move to shore up ownership of gold among its citizens in preparation for potential conflict in the future. So I think even China is expecting that somehow a conflict with US is inevitable. And to do that, it needs to boost up its finances. And one of the key things is to allow its citizens to buy as much gold as possible. Now, this could also have great ramifications. Now, assuming the Chinese citizens, 500 million of them can buy gold. They can buy 1 gram of gold per month. Okay. Now that 500 gram per month is equivalent to 500 million grams. Okay, 500 million grams can mean a few hundred tons of gold. And if let's say in 1 month, China can siphon off so many tons of gold from the market, it will create a disaster for the LBMA and also the COMEX-based gold exchanges. So I think, gradually more and more citizens will actually opt for gold, especially when they see that the global risks have actually increase. Okay, so that's all I have. Evelyn, back to you.
Okay, so let
Evelyn, can you hear me? Evelyn, you are under mute.
can you see my screen now?
Yeah.
Okay, good. So let's go through the summary and then we will go through some of the questions. Some of the questions we have already answered, but maybe I will just elaborate a little bit. Okay, yeah. So definitely in the summary itself, for the month of June, the transformation is ongoing and the technology war will be more intense because of the fire. So I think it also correlates with BC's research. Then more layoff is also expected. And just now somebody says about, the month of June, the branch is DE. So the DE is also actually is a fire element, right? So potentially the cash will have no values. Okay, anything that's DE means that no energy. Okay, so the energy sector probably will gain attention and beware of the overall market condition because the energy sector will gain some attention is because of the earth and the water combined is actually will also transform into fire. If it's successfully, then transformation is ongoing. That's why there's a transformation hexagram that quadrant is actually a transformation. Okay, so overall I would like to say that from the studies that I have is that beware of the current market condition. Okay, maybe the stock market condition, you need to beware that it's going to be quite volatile, and I do not know that whether there will be, it will be out of control. Okay, so over to you, BC.
Yeah, just very short. There's obviously more risk of recession. Tech war. Okay, actually this one I need to share my screen because I make some correction. Yeah.
Okay, can no problem. Go ahead. Let me stop sharing first.
Okay. Okay, so summary, there'll be more risk of recession and Ukraine war will intensify. Okay, as I mentioned, there'll be wider expansion of area, more geopolitical chess moves between US and EU against global South and vice versa. And I think yesterday I saw a Bloomberg report that US sanctioned Malaysia and Singapore because of its purchase of Russian oil, if I'm not wrong. Okay, so you can see that the US is getting very desperate. Okay, so de-dollarization will gain progress, and bankruptcies and poor economic conditions will trigger more layoffs. So again, if please go to our respective YouTube channel, like and share, okay, to help us gain a wider audience. Okay, now questions to Q&A, yeah?
Yes, there are a few questions here. Okay, let's go through. I think I have answered Augustine's question on the DE itself, that potentially there will be, indicators of government has no power also because on one branch represents the government. Okay, so and also David Young says that BC, would you mind to share which company that develops nuclear reactor that you talk about? I think you talk about China nuclear reactor, right? You see?
I will post this in the Telegram channel.
Yes.
Channel.
Okay. Yeah, I think it better for exclusively for our members. Is David our member? Yeah. Okay. So there are two questions from Augustine again. With increase in debt ceiling, will the M2 increase, especially if the Fed if the Fed buy the treasury bills? The T stands for treasuries, right? Yeah. And then there seems to be.
I think the main question, Go ahead.
Okay, so this is question number one. Would you like to answer question number one first, PC?
Yeah. So the thing is, right now there's because of the negative growth in M2, okay, there's not enough liquidity to absorb the almost 1 trillion that is required to be raised by the US Treasury. So how this will play out, I already given the two scenario. Either they have to engineer a fall in the market to push people into the US Treasury to seek the safe haven status of the US Treasury, or the Fed would actually have to buy. If the Fed buy, then that would signal QE, and that would then, of course, cause a stock market rally because it's QE. And of course, the price of commodity will also move up. But whether it fits into the Fed's agenda that they want to have QE as well as increase in interest rate seems very contradictory. So I think most important is not to expect which one will come out, but to watch which one will come out and then strategize from there.
Okay, the second question is there seems to be too many bad indicators on the US economy, but the stock market is strong. It's still very strong. What could be the reasons?
I think it is the Biden admin themselves want to, as I mentioned, they have revised how inflation is calculated so that it gives the perception that inflation is under control. It also give in fact, they have used employment, after US had 2 negative quarter of negative growth in GDP, they immediately say that, negative GDP growth is not an indicator of a recession. What matters is the jobs report, because jobs will actually show the vibrancy of the economy. So that is why you see that the job report has been manipulated, to how many jobs groups, every time breaking expectations. But the jobs groups is actually a survey which the Fed actually estimation of what the Fed puts in. Now the Fed likes to use the life and death model, which means that if let's say they just add in companies, because more companies are being registered, they will actually put in more, and they will actually employ more people. Okay, so that is how they use to inflate the job number. It's an estimation by using the life and death model, life and death model, okay, of companies. So as long as they keep on estimating that more companies will actually open up, more companies will actually employ more people, that's why you have more jobs groups. But do you know that after they announce the headline where the stock market actually goes up, in the following few months, they will actually revise the figure down, but no one really gives a care anymore. Okay, that's how they manipulate the jobs report. And the jobs report is something that is always based on U3. U3 is such that they take into consideration that every jobs that is reported equal to 1 employed person, but it includes part-time job. So if one person need to work 2 or 3 part-time jobs to feed the family, in the own person's experience is 1 person, but in the Fed's jobs report is 2 or 3 person employed. So there's a lot of double counting. So that's why the jobs report keep on breaking record. And through that, they keep on to the narrative that as long as jobs growth is strong, the economy is strong. And you know, when investors are seeing all the bad indicators, they have no other option but believe in hopium. Okay, well, the government says everything is fine. Okay, so let's put our money. Okay, jobs is still strong. So that is how they use the narrative to control the market. Okay, and yeah,
a lot of manipulation. And also another thing, I would think that the manipulation on the market is that as soon as the company that is not making money, they will start to lay off people. So this will save their balance sheets a little bit. So I think this is also why we have such phenomena, because we know that stock markets are always manipulated and they are all speculative.
and again, I want to add also that every time when the economy is bad, they actually put in the earnings expectation that is the worst. Okay, so that when the company beat that expectation, the share price skyrocketed. Now, Nvidia is back to its record high, but do you know that its year-on-year sales is actually down 14%, if I recall correctly? So how can it go back to its previous record high when its sales is actually much lower than previous? Why? Because Wall Street set the expectation so low that the company beats them. And when it beats them, then it makes the share price go higher. Okay, so that is how the market is manipulated by, do you know that for the members, if you all recall at one time I say that market expectation that the S&P earnings could fall as low as 20%, so after the earnings expectation, they put close to negative 20%. But then after the earnings session is what, they announced, well, the S&P beat the expectations, by climbing up 9% above expectations. So that is how they use the narrative to boost up the share price, because when the share price goes up, who gains? The management. They are the ones that will be selling into the market, whereas the retailers, they will keep on chasing. Okay, so you have to be very careful when the market has become so frothy, especially the S&P, where 10 stocks actually determine the entire S&P rise year to date.
True, because they're the one that determine the index now. Yeah, and also a lot of businesses are going bankrupt. How could it be good? Yeah, so it's just waiting to explode, I think.
Yeah, okay. It's like wrapping a fire with paper.
Yeah, one day.
Yeah.
Okay, so yeah, any more questions?
So if there's no more question, maybe we call it a day. Yeah, so thank you all. Please visit our YouTube channel. Even though you have seen this, you can just like or share it, to help us gain a wider audience. Yeah.
Travels to view this video, I think it will be good for you for your investment decision as well, that you will be more cautious rather than to just hope or based on the market sentiment, as BC likes to put it on hopium.
Yeah. Okay.
Okay, thank you.
So thank you very much and have a very nice week ahead. Bye-bye.
Yeah, okay, so I will see y'all, we will see y'all next month. Okay, bye-bye.
Bye-bye.